As investors in the UK, you've got quite a few different choices when it comes to investing your money. I know when I first started, I had no idea what to choose. So in this video, I'll go through two of the most popular types of accounts, explain how they work, what they allow you to do, and most importantly, whether you should choose one or the other. I don't think this is an easy choice to make, but let's compare and I'll give you my thoughts as we go. Let's start with ISAs. There's 5 different types of ISA if we include the junior ISA, but for this comparison, we're going to use the stocks and shares ISA. The key benefit with a stocks and shares ISA is that any gains that you have within the account, whether that be interest, dividends, or capital gains, is completely tax-free. So if you're able to grow your ISA account to a significant amount, and there are some people in the UK with over £1 million in ISAs, all of those gains will be tax-free. So when it comes to retirement, anything that you have within that account, you don't have to think about paying any tax. You could be earning interest on cash. You could be getting dividends from any stocks you have within that, and also any capital growth. So if you sell a company that's gone up in value from when you bought it, you don't have to worry about any capital gains tax. Currently, you can put up to £20,000 per tax year into an ISA. And of course, those allowances are always subject to change. But because so few people actually fully utilize that allowance, there's no expectation that that limit is going to increase anytime soon. You also can't carry forward any previous tax years as well. So it's £20,000 per tax year. Just because you didn't use 5k from the previous tax year doesn't mean you can then put 25 in the following year. So if you are coming up to April when the tax year ends and you've got some leftover cash, then make sure you get it in that tax year before the new tax year starts. With an ISA, you invest in exactly the same way that you would with a standard account, whether that's mutual funds, ETFs, stocks, investment trusts. All the ISA is simply a wrapper that sits on that account that allows you to get those tax-free benefits. A SIPP, a self-invested personal pension, as the name suggests, is a product for retirement, and currently you're not able to access until you reach the age of 55. That is increasing to 57 in 2028, and of course, again, this is always subject to change. It's likely that it will move in line with the state pension, running about 10 years below it. With a SIPP, the tax implications work in an opposite way to how the ISA works. With the ISA, any money that you pay in, you've already paid tax on that amount, but any money you take out of the ISA is then tax-free. With a SIPP, any money you pay into the account, you get tax relief at either 20, 40, or 45%, depending on which income tax band you sit in. However, any money you take out of the account could be subject to tax. So with the tax relief, when you pay money into the SIPP, you get 20% automatically added from your SIPP provider. They claim that on your behalf from the government. It can usually take a few weeks to hit your account, but you don't need to do anything from that perspective. So if you're a basic rate taxpayer, for every £100 that goes into your SIPP, that will actually only cost you £80 because you get that 20% tax relief. If you're a higher rate or an additional rate taxpayer, you still get that 20% automatically added from the SIPP provider, but then you also then need to claim the difference manually through your tax return. So an example for the higher rate taxpayer, which gets 40% tax relief, that £100 goes into your SIPP. You get the £20 from the SIPP provider, and then you've claimed another 20%, so another £20 manually through your tax return. So in effect, that £100 has actually only cost you £60 to go into that SIPP. And then likewise with the additional rate taxpayer, which gets an extra 5%. There is a limit of how much you can put into a SIPP, which is £60,000 per tax year, or 100% of your income. They put that bit about your income because, say for example, you had a £30,000 income, and you came into some inheritance that was also 30,000. You couldn't then put 60,000 into that SIPP because it would be over 100% of your income. You'd have to wait till the following tax year before you could put that amount in. So with the ISA, you get taxed on the way in, but you don't get taxed on the way out. And then the SIPP is the opposite, where you don't get taxed on the way in, but you do on the way out. When you come to retire and you want to take money out of your SIPP, you do get 25% of that tax-free, and then the 75% could be liable for tax. When you come to take that 75%, that works in exactly the same way that taking any income does. So you still get your personal allowance, and then you just move up the tax bands exactly the same way that you do right now. There's many different ways you can take money out of the SIPP. You can take the 25% tax-free cash all in one lump sum, and then anything left in the SIPP is just taxable income. You can take it out in chunks, so every time you need some income, you take it out, 25% of that would be tax-free, and then the 75% would be liable to tax. Again, obviously depends on other income sources you have. You still get the personal allowance, so a lot of is dependent on what your situation is. For some people, they take the tax-free cash and then they buy an annuity, which essentially gives you an income for life. And there's a few other different ways as well, which could be more tax efficient, but we won't get into that now because it's very specific and very unique to you. So now let's look at a comparison of the returns that we may expect in each of these accounts. Well, I'm going to use the example of investing £100 per month for 20 years, and we're going to use a rate of 7%, which is roughly what you could expect in real terms investing in the global market. With the ISA, after investing £100 per month for 20 years, ISAs, you would have around £51,159. With the SIPP, if we assume we're a basic rate taxpayer, which means we get 20% tax relief, that £100 is effectively £125, gives us £63,949. That money that's in the ISA has already had tax taken off it of when it went into the account. So that money is completely tax-free when you come to take it out. However, as we know, there is tax to be paid on the amount in the SIPP. We do get 25% tax-free, so we're only liable to pay it on 75%. But if we would take 20% tax on the 75% that's remaining, that would reduce our total to £54,357. You do get the personal allowance, but we're also going to assume that we have other income sources. And if we get to state pension age, then actually that's going to take up most of that personal allowance anyway. So this is assuming that we don't get any of that personal allowance. So you're going to pay 20% on all of the 75%. So even after taking that tax off at the end, you can see the SIPP has a higher amount than the ISA. So should we just go ahead and choose a SIPP because we're going to get more money in our account? Of course, it's not quite as simple, because with the ISA, you do get that flexibility. You can take that money out anytime you want. With the SIPP, we have to wait until that retirement age, which is currently 55, going to 57, and it's likely it would carry on increasing. Of course, with the ISA, all of these limits and allowances are always subject to change. Not only the allowance that we can put in, who knows, there may even be a cap on the total amount you can have within an ISA. So nothing is guaranteed, but we can only base on what we know right now. And that flexibility with the ISA could also be seen as a downside as well. If you're investing for the long term, for a retirement, if you have an account that you can't touch, that could help you stay committed, and it could prevent you from making bad investment decisions. It really comes down to what type of investor you are and what your specific investing goals are. It could be that you're saving for a house and you have a bit more of a hybrid approach where you still want to invest for the long term, but you know at some point in the next 5 to 10 years, you may have to take a chunk out to buy your first house. It could be that you're not very good at managing your emotions when it comes to investing. And when you see a recession or a stock market crash, you panic and you want to either sell some investments, or you want to take your money out and you really panic and it really gets to you. Then actually having your money in a SIPP that you can't touch and you can't take the money out, of course you can change your investment decisions within the account, but you can't actually take the money out. Then actually that could be better for you in the long run. It's a little bit like with a junior ISA. When you're a kid and a teenager and you see your parents saving for you in a junior ISA, there's going to be a point where you would love to have access to that money when you're 13, 14, 15 and go out and spend it and do all these things. But deep down, the most sensible thing is to let that money compound and grow. But what you think is in your best interest right now is not always your best interest in the grand scheme. And actually letting that money compound over time is going to be the best thing for your investment portfolio. But in reality, if you want to be a successful investor and make your money work for you, then both types of accounts are essential for you to use and learn the basics of. You don't have to have a one or the other approach. You can have them alongside each other. You could even invest in exactly the same, whether it's £100 into the SIPP and £100 into the ISA, and just having that accountability and the regularity of having that automated investments every month comes out of your pay slip. You don't have to think about it, and it's just done for you. That's how you grow your wealth long term. Of course, the more income you have, the more you can put into these accounts. But the longer you can stay invested in the market and stay consistent, that's what's really going to grow your wealth. Let me know if there's any other key differences that you would have included, and if you have a preference of one or the other. I have both a SIPP and an ISA with Invest Engine. I love that there's no fees on either of these accounts, and they do have generous welcome bonuses, which you can check out using the links down below. I hope you found that useful. Drop it a like if you enjoyed it, subscribe if you're new, and I'll catch you in the next one.